Shares of Gamestop climbed more than 75% today at its peak. That's coming up on Business Matters. Good afternoon, and thank you so much for being here with me. I'm your host, Don Ma. Of course, we're starting off with stocks. Indexes finished mostly lower today, and this is following soft manufacturing sector data and actually a glitch on the NYSE that briefly caused trading halts in several equities. So it was a choppy session today. Market is trading down based on concerns of the growth of the economy. We're getting some sluggish data here. So not only is the overall market down, the 10-year Treasury note is also down, and that's a sign potentially that investors are worried about economic growth because they're now buying the 10-year Treasury note. So we have an economic data-packed week coming up, so stay tuned right here if you want to get our unique perspective. Okay, as I mentioned, trading for dozens of stocks were halted actually today on the New York Stock Exchange over a glitch. So the NYSE says that the glitch has since been fixed and normal trading has resumed. Now, the website is saying that during the technical issue, there were large fluctuations in prices displayed for about 50 stocks here. So for example, Berkshire Hathaway Class A stocks were incorrectly listed as down 99%. And AMC Entertainment as well, Chipotle and Gamestop were some of the other affected shares. The NYSE says that there was no sign of a cyber attack. Instead, the issue is maybe related to a software update with the main electronic stock price publisher, and the exchange says that it's reviewing potentially impacted trades and will consider canceling those caused by the glitch. And I mentioned GameStop just now. Shares of GameStop soared today after meme stock influencer Keith Gill, aka Roaring Kitty, revealed a big money bet on the stock. NTD Sean Marshall has the details on that.
GameStop shares jumped as much as 75% at its peak on Monday after Keith Gill, Roaring Kitty on social media, a stocks influencer behind the 2021 retail trading frenzy, returned to Reddit with a post showing a $116 million bet on GameStop. It was Gill's first post in 3 years from his Reddit account. Screenshots of his aggressive GameStop trades triggered a rush of demand in 2021 for meme stocks. Meme stocks are usually companies with weak fundamentals that gained a cult-like following through social media hype. Some on social media think that the price of the shares will fall back down. I asked money manager Vijay Marolia for his thoughts on the meme stock.
I do not think that this is a safe investment. I don't even think it's an investment, Sean. This is gambling, sadly. The company is losing money. It's being pumped up by someone whose screen name is Roaring Kitten. So listen, to each is their own. And one thing that I hope is that he's trying to teach people. So Roaring Kitty, if you're listening and watching, then teach people. What is your thesis? Don't put a meme out there.
The screenshot posted on Sunday showed a GameStop holding of 5 million or 1.8% of its publicly available stock. Gill's last Reddit post from April 2021 titled Final Update showed a holding of 200,000 shares worth $30.9 million. Roaring Kitty's latest post on X was a mysterious Uno reverse card, which has confused many people. Vijay said usually it means he's taking the other side of the bet and shorting the stock. Short selling is a trading strategy where investors bet on a stock's decline.
I heard his congressional testimony, and I think he's hiding behind the fact that he's not an investment advisor and he's not investing money for others. But that's not the only law. It looks like he's breaking the price manipulation rules, okay? And it doesn't matter who you are and what you do for a living. If you do something with the intention of manipulating the price, then that's illegal.
Monday's surge also put GameStop short sellers on track to rack up nearly $1 billion in paper losses, according to data and analytics firm Ortex Technologies. Sean Marshall, NTD News.
So a lot happening today, and this is what I wanted to talk to you about next. Shares of media and entertainment company Paramount Global up more than 7% here today. And this is coming after a report that Paramount and Skydance Studio have agreed on terms for a merger. Now, according to a report by CNBC, Skydance would buy out nearly 50% of Class B Paramount shares for about $4.5 billion. The deal needs to be signed off by Paramount's controlling shareholder, Sherry Redstone. She owns National Amusements, which owns more than 75% of Class A Paramount shares, for which she would receive $2 billion if the deal gets through. So this is based on the CNBC report. Now, the deal could be announced in the coming days, so stay tuned for that. Also, former President Donald Trump joins TikTok, instantly gathering over 4 million followers in the past couple of days. This is, by the way, 12 times more than President Biden has. Here's the story.
The president is now on TikTok. It's my honor.
Former President Trump's first TikTok video shows him at a UFC match with UFC President Dana White. The new account launched over the weekend, attracting over 4 million followers, 12 times more than President Biden's 348,000. Biden's account launched in early February. This comes as Washington is trying to ban the app.
TikTok's really his only option. Getting very close to the presidential election, we know that he needs to be on social media, needs to have a social media presence.
Social media professor Andrew Selapak says Trump isn't going to other platforms because they banned him. He says Trump doesn't want X because he has Truth Social. But Truth Social's following is small. Selapak says what's left is the media.
If the media is completely in control of the narrative when it comes to him, he can't reach directly out to his voters, to his followers, to his audience, because they're not going to Truth Social. So he has to go where over 100 million Americans are, and that's on TikTok.
TikTok is popular among Gen Z, the oldest of whom are approaching age 30.
They're out of college, they're paying taxes, they're looking at cost of renting, cost of groceries, cost of home ownership. They're looking at the continual changes post-pandemic in the workforce, and they're probably a lot of them are really scared.
Media expert Dustin Siggins says Gen Z is generally liberal and may not like Trump, but he says if they think Trump is competent, many may vote for him. This comes after Americans donated $200 million to Trump's campaign since his conviction in New York. Eric Trump told Fox News that small donations comprise $70 million of that amount.
And let me also talk to you about the semiconductor industry. Competition there is heating up because Advanced Micro Devices, or AMD, has unveiled its latest artificial intelligence processor, the MI325X accelerator. So this new chip is going to feature more memory, faster memory bandwidth, and better computing performance, according to its CEO, Lisa Su. And the latest chip should be available in the fourth quarter of this year. Industry leader NVIDIA also unveiled its next generation AI chip platform called the Rubin. So CEO Jensen Huang said it's going to feature new graphic processing units, a new central processing unit, and advanced networking chips. The Rubin is expected to be rolled out in 2026. And moving on to oil. Prices tumbling more than $2 a barrel today. This is despite actually an OPEC Plus decision to extend production cuts into next year. OPEC Plus is a group formed by leading oil producers to exert control on the global crude oil market. So last year, OPEC Plus decided to cut production by 1.65 million barrels per day, and that was due to expire at the end of this year, but now has been extended to the end of 2025. And the move is in response to increased production in the United States, as well as reduced demand in China, which is important because it is the biggest importer of oil. And for more on how the move by OPEC Plus is going to affect oil prices, as well as gas prices that you pay, I spoke to Patrick DeHaan. He's the head of petroleum analysis at GasBuddy. Take a look. Patrick, thank you so much for your time this afternoon. So let's talk about the OPEC Plus meeting yesterday. Agreed on cutting millions of barrels in production throughout 2025. Any material impact here on prices?
Well, one would think that the extension of the production cuts would entail a response, a rise potential in the price of oil. The interesting development out of OPEC's meeting over the weekend was not only the extension of production cuts, which was, I think, priced into the market, but now also the fact that they're going to start phasing production back in. That was certainly an interesting twist on their meeting over the weekend. OPEC highlighting the extension cuts now going into 2025, but also the timeline for raising production again. I think that is certainly why the market is selling off today, is because of that information that OPEC provided, that is an end in sight to the production cuts.
So how much of an increase are we going to see after this move?
Well, you know, as we continue to see some OPEC members cheat their quotas, it's going to be interesting to see how the data comes out in the weeks ahead. I think for now, the immediate reaction was that oil prices briefly went slightly negative yesterday. Before after hours trading, they went up. Today, a very broad sell-off, oil prices down over 3%. And again, I think a lot of the market had expected those production cuts. What it didn't expect was that OPEC is now going to be restoring output, and that's why oil prices have gone negative. And for now, that's going to likely continue keeping downward pressure on what motorists are paying in terms of gasoline and diesel prices.
So looking at their record, would you say likely or not that they're going to stick to their target?
I think it's going to be a struggle. Now, we did see the UAE increase their production towards the end of 2024. That was a concession that OPEC brought. Of course, UAE had been making threats to OPEC in past meetings that they wanted to increase production. Now we're seeing pen to paper, OPEC increasing the UAE's output. But again, keep in mind that some of these countries, including Russia, have been overproducing, including Kazakhstan, have been overproducing their quotas with not a whole lot of enforcement action from OPEC. So I think that's why the market is broadly responding to this with a sell-off. And again, overall bearish undertones from this latest OPEC meeting.
So I understand OPEC had a target of about around $100 per barrel. Have they completely given up on that target of closer to 100?
I think they're going to be very hard-pressed to see oil prices going up to $100 or at least getting even to $90 a barrel on this announcement. We continue to see weaker than expected growth. U.S. gasoline consumption pretty bearish at this point after a brief rise for Memorial Day. We're seeing some of the weakest gasoline consumption this early in the year, or I should say this early in the summer, going back over 10 years. And I think that is providing some of the bearish sentiment that we're seeing. So I think it's going to be very hard-pressed for OPEC to get even to $90 a barrel, though if we do see a major hurricane in the next couple of months, keep in mind with these production cuts now ramping up in the third quarter, the third quarter, we could continue to see some pressure on prices, but really only if there's a major hurricane that would threaten Gulf oil production.
What would you say would be the main driver of gasoline prices in the United States?
Well, I think moving forward, we've seen the seasonal surge in gasoline prices. One of the wild cards could be demand. But like I said, some of the initial demand numbers from Gas Buddy showing an incredible weakness after Memorial Day. Our data showing an expectation of about 8.6 million barrels a day of gasoline consumption. That's pretty bearish. And I think that's why oil markets are just largely disappointed. Gasoline prices have continued to decline now. The national average in the U.S., $3.49 a gallon. That's the lowest tally we've seen since March. And it likely could decline another 10 to 20 cents a gallon here as we approach July 4.
All right. Thank you very much for your time today, Patrick.
Thank you.
Now, coming up after this break, Spotify is hiking prices yet again, less than a year after its last increase. We'll tell you if you're going to be affected. And France's sovereign debt rating downgraded, what it means for France and parallels to the United States. That's coming up after this short break. Don't go away. And welcome back. Let me go through some quick headlines with you to keep you as up to date as possible today. Can't turn down the volume on prices at Spotify because the audio streamer is raising prices for its subscriptions again. So this is less than a year since the last hike. Beginning in July, Spotify US subscribers will pay $1 more a month for the ad-free premium plan. And Tesla on the defense here. The electric car maker is pushing back after a proxy advisor urged shareholders to reject a $56 billion pay package for CEO Elon Musk. The company argued that his pay package motivated Musk to create, quote, tremendous value for shareholders. And the pay gap is widening dramatically for workers and their leaders. Data analyzed by the Associated Press by Equilar shows that the median pay package for CEOs jumped nearly 13% to $16 million, while wages and benefits for workers in the private sector increased about 4% throughout last year. U.S. manufacturing activity slowed for a second straight month in May, according to the Institute for Supply Management. And this is as new goods orders took its biggest hit in nearly 2 years. Construction spending also unexpectedly fell for a second straight month in April. Now, turning to international news, France has been hit with the debt rating downgrade. Standard & Poor's cuts France's long-term sovereign debt rating to AA- from AA. And the S&P said this was because higher than expected deficits would push up debt. Experts expect the rating cut to sting more politically rather than financially in the short term. And the downgrade is adding pressure on President Emmanuel Macron's government, as Macron's party is struggling to keep its lead in the polls ahead of EU Parliament elections next week. And will the credit rating cut motivate French lawmakers to rein in their national debt? I spoke to Daniel Lacaille, professor of global economy at IE Business School in Madrid and chief economist at Tressis Hedge Fund. Here he is. Daniel, good to see you. Welcome back. So I got to talk to you about this. S&P downgrading the French credit rating. What are your thoughts on that?
I think it's an important piece of news that is likely to be ignored by the credit market, but it says a lot because this is happening in the middle of the next generation EU fund. This is happening also in an environment in which all the fiscal rules have been eliminated, and therefore the French economy should be growing and reducing the debt. However, government spending continues to be way too high and significantly higher than tax revenues despite record levels of tax revenues. What this is basically showing is that the French economy does not work because of massive government spending and because of massive intervention, not because of challenges coming from elsewhere. And it's also showing that it's extremely dangerous to fall under the illusion that government spending and deficit spending are going to drive growth faster. That is actually not happening. And the example of France should be a lesson for everybody. You have to remember that France has been in stagnation for almost 3 decades. More importantly, that it hasn't had a balanced budget since the late 70s.
Do you think this downgrade will motivate the French government, politicians, lawmakers to do anything, to make any changes?
No, unfortunately, no. Unfortunately, what we are likely to see is that in the next European elections, there will be calls for even higher government spending, and that there will be messages of subsidies and all kinds of government entitlement programs. But also, unfortunately, more messages about the central bank monetizing debt, etc. That's ultimately the only way in which governments would like to get out of this massive hole.
And you mentioned markets earlier. It seems like you're getting at that there won't be much of a material impact. Why would you say that people don't really care about this?
Well, people don't really care about this because they're falling under the mirage of central banks are going to disguise all fiscal problems because a very large number of market participants simply ignore fiscal imbalances, thinking that the central bank just needs to implement another round of quantitative easing and rate cuts, and that will make everything fine for markets. It might work in the short term, but it's getting very close to a law of diminishing returns, and it's pretty evident, to be fairly honest. Bond investors in Europe are suffering quite significantly in an environment that is leading the European Union to stagnation with high inflation, therefore stagflation.
You know, just like France, the United States, not a stranger to credit downgrades as well. Are there any parallels between the U.S. and France?
There are parallels. France is way ahead in interventionism and excessive government spending compared with the United States. But if the U.S. economy continues to pursue a model that is based on massive government spending, unsustainable deficits, and constantly bloating the size of government and the economy, it will achieve it like France did. Let's remember that France was a thriving economy only 35 years ago, was a good, strong economy with big productive companies, with a thriving private sector. And it's easy to go slowly but surely increasing the size of government, increasing the size of bureaucratic spending, and believing that that is going to be fine because nothing has happened yet, which is the equivalent of accelerating in the middle of a race, thinking that you haven't crashed yet. No?
Thank you very much for your time today, Daniel.
Thank you so much. Have a great day.
Okay, just a couple more stories to go through with you today. The airline industry is soaring. Global airlines have raised their profit forecast for the year as a record number of passengers go airborne. So the International Air Transport Association now expects the worldwide industry to generate $30 billion of profit this year. Passenger yields are expected to strengthen this year as well, and that's the average amount paid by a passenger to fly 1 mile. But airlines warned that it might not actually be able to keep up with travel demand due to global supply chain disruptions. This includes deliveries of its own fleets. And finally, with no new wide releases in theaters this weekend, last weekend's big 3 movies renewed their box office battle with a different outcome. We have the early estimates for the top 5 films.
Why are you here?
I think there's been a misunderstanding.
The Fall Guy stayed in 5th place, hitting the 80 million mark domestic with a $4.2 million weekend. Kingdom of the Planet of the Apes made $8.8 million for 4th place and $140 million domestic. Furiosa, a Mad Max saga, fell from 1st to 3rd, earning $10.75 million for a 10-day domestic total of $50 million.
Hi. Well, looky.
If moved up to 2nd place, crossing the 80 million mark with ticket sales of $10.8 million.
Shred sequence initiated.
The Garfield movie rose to the top spot, earning $14 million for a 10-day domestic total of $52 million.
All right, and that's all the stories we have for you today. Thank you very much for watching. And if you have any feedback for the episode, please feel free to let me know. You can email us at business@nttd.com or leave a comment online. I do read them, mind you. One last thing that I always say, business matters. Goodbye, see you tomorrow.